Good evening, and welcome to today's market wrap-up. If you're looking at the numbers, you might be wondering if we're looking at two completely different worlds. Because the divergence we saw today was nothing short of extreme. Let us start with the US side. The Dow Jones Industrial Average posted a solid gain of 1.03%, leading the major indices. The Nasdaq, however, slipped by 0.22%, while the S&P 500 managed to eke out a modest gain of 0.21%. Now here is the key takeaway. This was not a broad-based sell-off. Instead, we saw a very clear defensive rotation happening within the US equity market. Money moved out of high-flying tech names and into the value-oriented blue chips that make up the Dow. And the supporting data backs this up. The VIX, often called the fear gauge, dropped by 2.46%. The 10-year Treasury yield fell to 4.6%, down 0.8% on the day. Both of these moves suggest that the market is not pricing in a recession or a panic. What it is pricing in is a soft landing narrative combined with the expectation that interest rates have peaked. But if you shift your gaze to Asia, particularly the Chinese A-share market, the picture could not be more different. The Chi-Next Index, which tracks growth-oriented tech stocks on the Shenzhen exchange, absolutely collapsed today, plunging by 7.34%. The Shenzhen Composite Index was also hit hard, dropping 4.52%. These losses are far beyond what can be explained by the modest moves we saw in the dollar index or the Treasury yield. This tells us that there is an independent and significant micro-level risk being unwound in the A-share market. Capital is fleeing high-valuation tech and growth stocks in droves, and some of that money is rotating into safer havens like the Shanghai 50 blue chips. So to put it simply, the dominant capital flow in the US today was a defensive rotation. The dominant flow in China was a panic-driven exodus from tech. So why this massive divergence? Let us walk through the day's path. The Asian session was dominated by the Chi-Next meltdown. Selling was relentless from the open, and expectations for northbound capital outflows quickly intensified. But then something interesting happened when European and US futures came online. The S&P futures were trading up 0.43%, and the Dow futures were up nearly a full percentage point. They did not follow the A-share market lower. This was a critical signal that the Asian sell-off was a regional event, not a global contagion. When US markets opened, the rotation continued. Money did not flee into cash or gold. In fact, spot gold fell 0.53% today. Instead, capital simply moved from the Nasdaq into the Dow. It was an internal rotation, not a market-wide exit. The biggest surprise today, and our biggest miss in the morning forecast, was the complete disregard for the positive policy news out of China. The State Council announced new venture capital support measures, which should have been a tailwind for the Chi-Next. But the market completely ignored it. Instead, it focused entirely on the negative headlines. The upcoming tariff deadline of August 1st, the new BIS entity list, and unconfirmed rumors about applied materials in Xi'an. The policy good news was completely overwhelmed by the trade war bad news. This is a very important lesson for our model. We also observed a new structural signal today. The traditional correlation between the Chi-Next and the Nasdaq broke down. Capital did not flow across markets in a coordinated move. Instead, each market completed its own internal style rotation independently. We assessed the probability of this new regime at 70%. Looking ahead to tomorrow, our base case for the A-share market is a lower open followed by weak consolidation. The key support zone to watch is between 3,200 and 3,327. If the Chi-Next opens above 3,200 and then stabilizes and narrows its losses in the first hour, that could be a signal for a technical bounce. But if it opens below 3,150 with no buying support, we would stay on the sidelines. For the US market, we expect the Dow futures to continue to outperform the Nasdaq, with a probability of 60%. The defensive rotation should have some legs, at least for another session. The 10-year Treasury yield is likely to trade in a narrow range between 4.55 and 4.65%, as rate expectations remain stable. Gold faces a key test at the $4,000 level. It needs to hold that level and close positive to maintain any bullish momentum. Let me give you a clean and actionable conclusion. We are in a regime of extreme structural divergence. For the A-share market, the strategy is to watch and hedge, not to chase the dip. For the U.S. market, maintain long exposure to defensive value, but avoid net long positions in the Nasdaq or Chinese tech growth stocks. The first hour of trading tomorrow will give us the critical volume and directional signals we need to make the next move. Stay disciplined and watch those key levels.